All right, the meeting is recording. Awesome. I hope everybody can hear me. Let me just start with this disclaimer. It's always best to recite it. Can we all mute our mics? Thank you. It's always best to recite this disclaimer in case somebody starts acting recklessly and tries to report me somewhere. So the material I'm sharing today is strictly for educational purposes only. I am not in any way a financial advisor, and this is not investment advice, right? Trading involves real risk, and you can lose more than you have invested. Always do your own research and never trade money you can't afford to lose. With that being said, thank you so much for joining us today. Welcome to our fourth lesson of our series. Today we'll be getting into a concept that helps me time my entries with more precision and avoid chasing price. And then we'll be looking at internal range theory today. Now, let's get into it, right? Internal range theory is a framework I personally use to track how price behaves during the early parts of the trading day, right? First, it helps me anticipate two things. It helps me anticipate where liquidity is being built and where price might expand from later in the day. When I say internal range, I'm referring to the price action that forms during the Asian session and early London session, right? This is usually tight, low in volatility, and full of trapped liquidity, really. I treat it as the accumulation phase of the day. On the past lesson, we are about accumulation and distribution and manipulation. So I treat it as the accumulation phase of the day, right?
All right. Are you moving your slides? Because I think
Ke santse ke le mo internal range theory.
I think super the disclaimer.
Hey, man. Okay. Is it the same case for everyone?
Yebo, ntse e supa disclaimer.
Oh, serious? How about now?
Still. Ke wa recorder ka now.
Yeah, I'm recording. Oh, wait. Oh, Jesus Christ of Nazareth. What I opened two presentations. Eish, wait. What are they part of we see I thought. Okay.
Wait, o ra gore no batla go tlhalosa ka yone internal
So
range theory kana ne le sele hela.
no, I opened two presentations. Ebe ke presenta e ke sa display mo meeting. Can you see now? Wa khona bona ke change screen?
No, gompieno ga supa sepe.
Ba fit. Etlhaban.
Ke e siame.
Okay.
But gongwe bangwe ha ise change mme ko go nice changes.
So mo internal range theory right now, I get.
Yeah.
Okay, let me see. Let me test one more time. Gona na internal range theory, like explanations and stuff.
Mo go nna ntsalo.
Yes, sir.
Oh, great. Let me just.
Now it's back to close the other one kana go iragale. Wait.
Oh, how got it now? Am I sharing the full? I think I'm sharing my whole screen. Let me see. Oh, oh my God. Ow, my feet. Ow. All right. Okay. I think. Please tell me on which page am I on?
The second slide, the internal range theory topic. It's not
No explanation, no explanations. It's not explanation.
Something ain't right, guys. Mm-mm. Let me just share my whole screen. Kana nna ke mo paging e se. Ke mo paging ya internal range theory no gore na le everything like the explanations and stuff. Let me just share my entire screen, right? So if you find yourselves hard luck. Can you see where I'm at now? Internal range theory, like the explanations.
Yes, sir.
Awesome. Like I was saying, the internal range theory is just a framework, I use, right? I personally use to track how price behaves during the early parts of of the trading day, right? It will help me anticipate that which is where price might expand from later in the day, and then where liquidity is built, right? And your internal range, I'm talking about price action it forms during the Asian session and the early London session. So the Asian range is just your the characteristics low volatility, and it's just a lot of liquidity being created with wicks, and people being taken out and stuff. Or just a range, what it's slowly moving up and down. It so we treat it like accumulation phase, like of the accumulation phase of the day, right? That's basically what the internal range theory and what the internal range is. So how do we apply this in real time? Are you on the screen, sir? How I use it?
Yes.
Awesome. Okay, and mine, by the way, Coco Melon today wants to watch me teach, so she's just right here watching.
Awesome stuff.
Great. So how do I apply this in real time, right? First of all, we mark the Asian range. Every day I start by marking the high and the low of the Asian session. This forms my internal range. I'm not trading there. I'm just observing. This is sort of like my liquidity map. And by the way, the Asian range is similar from, again, New York time all the time on Modi Chatins are on New York time. That's GMT minus 4, if I'm not mistaken. Um, the New York time, the Asian session in New York time is from 7 p.m. until 12 midnight. So you're going to mark the high and the low of that period of the time. So let's say Thursday today. Thursday, I mark my Asian session Wednesday. So horar ke marka from Wednesday ke marka from 7 p.m. until midnight. That's 000 hours, 0340 hours, right? And then the second step, we wait for like a liquidity sweep or a raid, or a raid of liquidity. So usually during the London or the New York session, price will just raid on the one side of that range. So you should know what it's not random, it's just liquidity grab. So big players are just clearing out stops and building positions for Rona, the smart money or the institutional traders, right? And then step number three. Step number three is to look for a reaction. So once price reads the one side, I look for signs of rejection or displacement. Displacement, I'm all about Buakayon. Agre, we said we wait for, like, on that move around the ATM, we wait for price to take a previous high, and then the sort of like price breaking down with displacement, right? The candles will be showing momentum in the opposite direction, and then tota, that's my cue that the real move is about to start unraveling, right? And then step number 4, now when I wait for a retracement. So typically this is just a retracement back to maybe a fair value gap that was formed during that market structure shift with displacement, I get. And then this is where you get to use the optimal entry, the optimal trade entry, which is the OTE, which I will teach in the future. Or we use a breaker block, and that's when I start entering. So this is what I go to this move on its own. I call it the expansion phase. The expansion phase, where price gets into that fair value gap and then expands to where we want it to go. That's the expansion phase, right? So you might wonder, why does this matter? So it you might think to yourself, or why this is important. So because it keeps, first of all, it keeps me patient, right? I don't get emotional. It doesn't, it sort of helps me not try to chase price during the range. Movement marketing was go enter, that logic behind it. Or why are you entering there? Did you see a market structure shift? Did you see price coming back into a fair value gap and trading that? No. The intelligent range thought I just access as a map for that trading session, and with that map I know where the market is likely to look for stops, and I know when the real move is likely to come. And that real move usually comes during the New York session. Like I said, remember, we use the just to summarize this, we use the internal range forms during the Asian and the London session. I get the Asian session, like I said, you should probably write this down. The Asian session, how we mark out on the charts using the New York time, you mark it from 7 p.m. until 12 midnight. And then the London session, you mark it from 2 a.m. until 5 a.m. between those times you mark the highest at the highest points of those sessions. So between 7 and 12, 7 p.m. and 12 a.m., you mark the highest point and the lowest point. And then between 2 a.m. and 5 a.m., you mark the lowest point and the highest point. And that's your Asian, that's your ranges. That's that Asian range and your London range. We are going to use those highs and lows to tell us a story where price might go. And then these these internal ranges, they act as liquidity zone for Ronadi smart money traders or the ICTs or the institutional traders to operate around. And then I get to use it to anticipate the stop hunt, right? The fake out, the positions, say, and then I position myself for the true expansion move, right? Usually during the New York session. When I trade, I only mark the London and the New York session. I think the London and the Asian session. The New York session I can't mark because it's game I start. I know when it starts, and I know I know what I wanted to do in order for me to participate, right? So all in all, just this theory has helped me to just stay on the right side of the markets by thinking more like an institution. Like maybe, what institution do I know you're trading? Trade. The only money he's going to be trading, but he's still raking in billions of dollars every month. Imagine. Anyway, well, that's all for today. That's a wrap for lesson now, internal range theory. So if this clicked for you, you should just go back to your charts and mark your Asian ranges this week and this total. Each and every day you should be marking those ranges so that you can look at them and start seeing what happens around that. Don't worry, we're getting into the charts right now so that I can show you, especially around the activity that I did today, the trades that I took today based on this particular theory, right? I use it every day, every trading session. So let me just change my screens and start diving into the charts. If you have any questions, feel free to ask. My screens. So, this is just a quick point of view of my charts for today. Remember, am I audible? Can you see my screen?
Yes, you are. I can see your screen. You are audible.
Awesome. Remember, I had said if the market, this is from the previous days, the markup scenario did on the previous days. Remember, I said if the market is going to go high, it's either going to retest some, I don't know, PD array in the premium. And then the first one that it reacted to was this fair value gap right here. I usually call it a sell side imbalance, buy side insufficiency. I will teach it in the future so that you have context around that. But in simple terms, it's just a fair value gap. Price reacted to this fair value gap and then broke down. That's the trade that I took. And then price went up, took out that high, got into what it, if at all you were looking to, I don't know, buy this range, and then you missed your opportunity price in the more premium, because like I said, you don't buy premium, right? Price gave other traders an opportunity to enter right here. If you look at this, this is just one of those things that we use to trade. What is this? It's a fair value gap, right? If at all there's an institutional trader or a long-term trader, short-term trader who missed the opportunity to buy at the bottom here, they were given another chance here. They put their buy entries on the discount. You see, price came back to discount and then moved up. Guess what? Price got into discount. I was hoping to see price react to this level, which is a previous week's new week opening gap, because price is still, even though it's a previous new week opening gap, price is still reacting to it beautifully, marvelously. So what we also see price doing, I marked a 4-hour volume imbalance that occurred, right? We could call it an inverted volume imbalance. We will talk about inverted fair value gaps and volume imbalances in the future. Don't worry about that. But we could always say price was reacting to an order block and a fair value gap. Which fair value gap? This fair value gap on the 4-hour. If at all you were looking to take a trade based on price reacting to a higher time frame point of interest, which is a fair value gap, or a higher time frame PD array, which is this fair value gap. Of course, price came and surpassed the fair value gap to the high there. It's fine. This is what price will always do. That's why the entries are on a fair value gap. Can I buy a reseller a fair value gap? We don't put our stop loss at the top of the fair value gap. We put our stop loss at the top, at the high, at the swing high that caused that fair value gap, right? That caused that displacement leg, right? If at all you are somebody who trades the 4-hour time frame, this is where you are going to put your entry on. Like, this is the time frame that you use to buy or sell. This would have been your entry, and then the high that caused that displacement would be your stop loss. When your entry would probably be, I don't know, down here or something. That's fine. Now, one may ask, okay, we get it, Tato, price to that volume imbalance that you were talking about. Cool. What now? Now I would take it as this is my opportunity for price to go down, right? This is my opportunity for price to go down. And okay, I made this analysis on Sunday, and I keep refining as time goes by, seeing where could price retrace to. I don't usually go as further as the daily or the weekly time frame. The 4-hour is enough. Of course, the 15-minute time frame is enough for you, right? As long as Sunday would relay your due diligence and you're just trying to make sure that you mark you mark up your charts for the week and week or announce or check maybe 4-hour daily or even the weekly, depending on your liking. I will not use these charts today so that, because I can't my charts. Everything that I've drawn here is important to me. So let me just use a different one. So how would you determine a range, right? Of course, a range, you can use any kind of range. You could start, what a range is usually formed by a swing high and a swing low. Remember what I said, a swing low and a swing high are? Or how do you see them? Or how would you mark, or this is a swing high and this is a swing low? I hope everybody remembers this, because we were talking about a 3-pattern candle. You have 3 candles. When you want to determine a swing high, right here, this right here is a swing high. Why? Because we have the middle candle being the highest, and then we have the candle on the right, so on the left, being lower than the candle on the middle, and the candle on the right being lower than the candle on the middle. This is the swing low. So if you still quite don't understand what swing lows are at the moment, just practice. Go in the charts every day, look for price points in the swing high and a swing low, right? This is a swing high, this is a swing high. You should be at a point in where you just can mark it easily. So in this range, a range, like I said, it's formed by a swing low and a swing high. This right here can be a range. This swing high and this swing low, this can be called a range. You can have this swing high and this swing low being a range. You can even have this swing high and this swing low being a range. But I don't like having to call this a swing low because price is still printing. You never know. This candle might even come down a bit closer below this. So we are still ranging between right in this price action. Our range. Okay, this swing low is taken out. So now our range is from this swing low to that swing high. So if you were to mark it with a Fibonacci tool, this will be your range. You would know then, right here, this price range, it's your discount, and then go premium. But I'm just going to be looking at the price section in in the morning when I was preparing to take a trade. So what was I looking for in the morning when I was trading? First of all, I like to mark my trading sessions, right? We start Thursday, I mark Wednesday's trading sessions. That's the Asian and the London session. Thought that the London session is gonna be today because it's at 2 a.m. I get it. So Wednesday's Asian session starts from 7 p.m. New York time until 12 midnight. So I use this thing at the bottom, this scale at the bottom. So how to have it shows you Wednesday, Thursday, Tuesday, yeah. So I'm going to hover around and then have 7 p.m. It starts here. So I'm just going to take my rectangle, select my rectangle right there. Okay, hover 7 p.m. until 0000. That's here. And then where's the lowest point of this session or this period? It's right here. The highest point of this period, it's up there. So basically this is my Asian session. Asian, maybe it's like a range, so that gets kind of confused. Asian range / session. Right? And if I want to extend it out even more, I'll just come to this low, extend it out to the far right. That's the Asian low. And mind you, keep in mind, as I am marking my charts up, this is how you should be practicing and marking your carrying out your back testing sessions. This is how you should be back testing. Asian low, and then right here is your Asian high, right? That is marked, it's fine. And then we now mark our London session. When does the London session start? It starts from 2 a.m. until 5 a.m. New York time. So this is 2 a.m. and where does, let me draw that rectangle, 2 a.m. until 5. 5 a.m. right here. So this is the highest point of the session and the lowest point of the session. So what I'm going to do, I'm going to change the color of the, let me make it blue because I get it. Can't the color of the flag of London? I think in a little blue, little red. It's fine. Let me just use this blue. So yeah, this is the London range, and then I'll mark the London range low, kind of the London session low. Like it says slimmer line because I really don't use the London session a lot. What I use the most is the Asian range. That's what I care most about. And then I mark the high of the Asian range at the London range or London session. So I'm not gonna mark and label the lines because it's not one. So this is the range arona. This is our Asian range, our London range, and then this whole from this point to this low. This is our price. Our price range and our Asian and London range, right? On this own, this section orange. This is our Asian range. And then blue, this is our London range. And then if I could just make it easier for you to understand, hakim thing until here. Let me change the color to pink. This whole price action from this point to this high, this is our price range. We even sometimes call it the dealing range. This is where deals are being made. That's your buys and sells, right? Cool. I don't usually trade this range because it's usually price is usually just consolidating. Yeah, like when I price consolidating up, down, and then of course, like we were saying on the slides, this range, the Asian range, is usually going to be taken out, or one side is going to be taken out during the London session or the New York session, right? So when we go down to a lower time frame, let me teach you how I now start looking for my opportunities and where will I be looking at. Just keep in mind also, the Asian session, to see where price will probably be attracted to. So now in the morning, ha ke tsoga phakela ke itlhela price ya go godimwana ebile ke makile my Asian range ya go godimo. I'm happy. I know what during the New York session, I want to see price go take out the London low, not the Asian low. Why? Remember on our previous lesson, we were talking about if you mark a high and a low of a range, like we were speaking, the first side that you see being taken out or being swept, which is a liquidity sweep, expect the opposite side of it to get swept next or thereafter. And the reason why I was also marking the times during the New York session, those are the times that I start looking for opportunities to participate in the market, is because I know there's a higher chance of the market to reach my target during that time frame. Why? Because the New York session is by far the most busiest trading sessions you could ever have. Even if you look at the back at old price, of course, Harakhan, this you can make a living off. You can make money off this London range, right? You can make money. You can look at this. We had a market structure shift here. The market structure shift here. We had a fair value gap being formed in that market structure shift. And then what did price do? This low was formed after taking a previous low, and then you had a market structure shift with displacement. And on that displacement leg, you have your fair value gap being formed. It's beautiful. Even this one, if at all I was a London session trader, this would have been my entry. And then what happens? Price immediately runs back down, takes tests the fair value gap, and then expands higher. But of course, I wouldn't take this because first of all, I don't specialize in the London session, and then of course, now if at all I was trading the London session, I was going to be a sore loser. Look at this. This high was taken out, and then I would immediately expect how the price is going to come back and take the low, right? I would always be losing this. So it's the reason why I don't trade the London session. I used to trade it based on what I've learned about the Asian high and low. I'm taking just my ass being handed to myself because I'm always just waiting for the high to be broken and then me running to try to grab the low of the Asian low, right? Not by the time I didn't understand this low would probably be taken out during during the New York session, right? Cool. Let me just remove this. I was just showing an example of this thing, fair value gap of this market structure displaced. It happens all the time. You just have to have a narrative behind your trades. So here, this Asian session high is taken out during the London session, and sure, for me it's like great. The Asian session, the higher thing it's I'm looking now and hoping the law is not taken out during this session because it can easily happen. And usually when that happens, I have I doubt I would even take trades during that time. The day session like the Asian session, it's sort of both the lows and the highs. I wouldn't take the trade on that day. So yeah, the high was taken out. Cool, I noticed. And then I let price go helalo. When do you start looking for let me check, there's a notification down here. Is that a comment? Let's see. I'm experiencing network problems. Do share the materials here. Sure, like target la share a video after this out. Then you have the Asian, sorry, where was I? Yeah, you have this price action now happening after the Asian session is the high is taken out. So what do you have left open? You still have this low. You have this low still open. It's still not taken out during this price action here. And you would ask yourself, Tato, when do you start looking at the price? When do you start looking for an entry? Like I said yesterday, I start hunting for my trades at 8:30. You would start doing that at 8:30. That's fine. Now I usually start at 9:30. 8:30, I start looking for stop hunts. Where did we have previous lows or previous highs being taken out? So in this particular case, I'm actively going to be looking for previous highs being taken out. Because why? Just like from our previous lesson, I wait for relatively equal lows and highs to be taken out in order for me to have said, well, okay, I'm starting to look for my for my market structure shift with displacement, formation of a fair value gap, and then price trading back into that fair value gap, right? Cool. Then 8:30 kyo chile, drop leading news. I'm waiting. Where do we have our high been taken out? The previous high that we first see being taken out, this swing high right here at the top. Of course, yeah, this, but okay, look, okay, but sorry, Tato, what's I choosing this high? What's I choosing this high? Yeah, what's I choosing this high? Of course, price took out this high. It's cool, but did you see price breaking down with like a market structure shift with displacement? For me, a fair value gap? No. How about this high? Even I might be wrong. How about this high? Did you see price after taking this high? Do you see price breaking down with displacement? Formation of a fair value gap? No. Of course, there's displacement A, but there's no fair value gap being formed here. How about now? This high right here. Do you see something happening right here? Market structure, that thing, displacement. But where is the market structure? I start going down to a 1 minute time frame. And then that's when you get to see all the magic, right? That's when you get to see all the magic happening, right? And a lot of people would have got into this trade. No, this would have been an easy loss for a lot of people. This is a market structure shift with displacement, blah 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 blah, right? Look at this. Let's just look at this. There's some of you looking at this area, but I can remember a previous high being taken out. Cool. Displacement. Cool. Market structure shift. Cool. Market structure shift to Oka. This break of structure. Market structure shift. The previous low being taken out. Again, market structure shift. Cool. Harkhan. But how we mark fair value gap here? You have market structure shift here. Is it something that you can trade? Oh, sorry. Let's see. Is this something that you can trade? No. Why? Because this fair value gap, it's not even on premium. Because remember, I told you we have to sell premium and buy discount. I mean, it's not even close to premium. This is not close enough for me. Close enough, but I usually never take that risk unless it's a very aggressive trade. Most of the times, I like to safeguard my money. I don't want to lose $10 my account. I don't want to lose money because I felt like prices go wow in here. On this displacement leg, this one, this fair value gap is not even on premium. I wouldn't take this because I would like to see displacement. Sorry, I would like to see fair value gap in that market structure shift. Because I new lows. This is a new swing low. I want right here. This is a new low. I want it in this leg, displacement leg. In the swing low, one. This one swing low price. No, I don't want that. Right? Cool. Let's take that out of the way. Then price came, took this high, and then immediately after taking the high, it broke down. And it's still within our time, our 8:30 until, let's mark 11. For you guys, let me just mark 12. Now I got to a point where I've refined my trade so much. Well, you know what? I just look between 9:30 and 11, and that's it. So after price took the high, we were expecting what? A market structure shift with displacement. Displacement there on, all right? This is our displacement. Where do you see the market structure shift? A market structure shift, like I said before, occurs when a previous low breaks the market structure, right? And make sure that market structure shift, price closes. The price thing, the candle thing, sorry, the candle thing closes below a previous, so it closes below the previous low's low, like the lowest point of this candle, this swing low. Make sure gore candle thing it closes gore ska itlhela or o ira tla ke batla example one or market structure shift ya gago ke where can I there's no point where I can choose. Let's say, let's take an example. Let's assume this is a swing low, and this is your market structure shift, right? Oska ipitlela ore price this low, the market structure shift one. This is your this can be your market structure shift. If you want to make sure you take the trade it's a relay, let your market structure shift be just ele candle ele enclosed. It's can let's assume also we are looking for a market structure shift to the upside, right? This point in price, let's say this is your previous high you're looking for in market structure shift. It shouldn't be like this where the previous wick candles wick. High listen when this high, this would qualify to me as a market structure shift. It's beautiful, like this. Displacement. I don't want that. So yeah, let's continue. This has got 3 minutes. This point in price, this is a swing low. Why? Because the middle candle has the lowest point than the candle on the left and the candle on the right. Right? Cool. And then this market structure shift. So between this candle and that candle, there is a gap in between. This is our fair value gap. Now, as this has happened, I have marked my fair value gap. I'm cool. This is my market structure shift. I'm waiting now for price to trade back into that fair value gap. Does it trade back? Of course it does. So this is where I put my entry.
Just wait a minute. Normally, how did you identify that fair value gap? Something.
All right. I was saying a fair value gap is a formation of the candle Z3, right? So these candles, in this scenario, these candles are supposed to be having let me do this. This is our fair value gap right here. So formation of 3 candles, right? Let's say these candles, formation of candle number 1. Let me try labeling them. Candle number 1, candle 2, candle number 2, and then candle number 3. So our fair value gap, we want to see a formation of this candle number 1, and then have displacement on candle number 2, and then candle number 3 the wick thing. This a space between the high of candle number 3 and the low of candle number 4. Candle number 1. Right? The fair value gap between the high and the low, the high of candle number 3 and the low of candle number 1. Right? So okay. What then we wait for? Error.
Yeah. So it doesn't matter which candle combination it is. They don't have to be all bullish or bearish,
No,
right?
they don't necessarily have to be all bullish or all bearish.
Okay.
As long as this price, this candle in a unfortunately 1 minute elapsed before it could even become a bearish candle. That's still fine. That's why this following candle it boots without even having to go up. If it had went up a week, that was what I was telling you the other day. I already know how price is going to print. If at all it wants to go down, and then the next candle prints rapidly down, I'm going to expect the other candles to print a bit up and then continuing down.
Okay.
Right. So yeah, this is how a fair value gap is formed. Vice versa, if this was a bullish scenario, it would still print in this manner, right? Here, this is candle number 1, 2, and 3. The fair value gap is between the high of candle number 1 and the low of candle number 3. So this space between the high of this candle and the low of that candle, right? Cool. So this is the fair value gap that I marked. Why did I mark it? Because it's within the displacement leg. Of course, displacement can come in 3 different or even more candles. Let me look for. This could be displacement, right? And then you'd have even multiple fair value gaps. That's what I was explaining the other day. Which fair value gap do you then get to use? I was showing an example. I was showing an example of there are probably people I know. There are probably people who use this as an entry selling down, and also there must somebody be there using this as an entry selling down because price came up, but there is no market structure shift. You know what? It's valid because this is a formation of a new low or swing low. This yeah. So yeah, what do we have here? Price makes that fair value gap. It's like a rectangle. Because I used to struggle in Nalantla with this, so it would be easier for me rectangle. That's your fair value gap right here. I extended to the far left. The minute price got here, this is your point of entry, right? This could be where you put your first trade. How long missed this first point? There are other points again. This candle, right? Another one. Great. Another point. So there were 4 opportunities for you to sell right here. And where would you put your take profit? Where would you put your stop loss? Right? Based on what we are targeting, price took that Asian session high, took the London session high. Now we want to see price go take the London session low and the Asian session low, right? Let me do this. This is our target. So you could have 3 targets or even more. Because at this point, I had put two trades open on this trade today. So this equilibrium point here is the equilibrium of this swing low until that swing high in a remarkable, right? And then
Can I request something? Is it possible for you to mark the New York session like you did the other ones, in terms of movement?
Okay, I usually don't mark my my sessions the New York session, because the New York session typically I mark it from when it starts to when it ends, from 7:30 until 4:30 p.m. but I'll just mark my kill zones, right? I'll mark from 8:30 until 12. So where is 8:30? This is 8:30, so this is the high of the Asians at the New York session until 12. 12, okay. This is 12 right here. So 12, okay. Oh. So even hella still in this shaded area, you're nailing the New York session, Aaron. There is still much more price action and activity and volatility. For me, this is price. Of course, this is price going gradually up, but of course, it is gradual. It wasn't as rapid. More price it goes up and down, up and down. So you will experience how it is to trade the New York session. It's scary, but once you have this in mind, it's going to be easier for you. So let me just remove this. How like I was saying, the reason why I mark from 8:30 to 12. 12 here we the lunch session, the lunch time. Like I usually then wait for from lunch from 12. If I want to trade the afternoon session, I trade from 1:30 until 16. That like I trade from 13:30 to 16:10. So 13:30. There's volatility here. 13:30 is here, and then 16:10 is. One day the macro. There are things that we call macros, and they occur at specific times of the day. This is where price moves at a very rapid rate. We put our music right? That's fine. But let me just. I hope you saw the London the New York session. But don't worry about it. Can include a more slide in the display. The specific times, the land that's all the sessions, right?
Okay.
Yeah. So, like I was saying, let me use this tool to show you where I put my entry. That was my entry there, and then my stop loss was just at this high, and then my entry I was aiming to take out my profits at the first fair value gap that I see beneath equilibrium. The first fair value gap that I saw was this one. So this is how you could frame your trades. You sell while you're in premium, and then you could take out your profits on any PD array. Like I said, a PD array is any fair value gap, order block, volume imbalance, or a previous low that you see on either the premium or discount, depending on where price is coming from, right? So price was coming from premium, and I'm aiming to take my profits just at the next or at the fair value gap that's on the equilibrium. Of course, I could have taken my profits like on this low, right? Or even this one, yeah, you know what, it's on premium, I think on near equilibrium. That's cool. Why? Because look at how price started acting after taking this low on equilibrium. Yeah, you know what is close to equilibrium. It started retracing back. Price gave people opportunity to like move away, like remove their, what do you call it? Remove their trades, because price might be going back now. Because I got to the price moves from premium to discount, then from discount to premium, premium to discount, discount to premium. That's how it goes. So the next trade, let me teach you something called pyramid entries. A pyramid entry is just you reducing your entries as your lot size is as price goes down or up. Let me look for a triangle. Do we have a triangle here? Oh, there we go. Let me see if I can. Ooh. Okay. Here one. All right. Okay, this is how it is. This is why we call it a pyramid entry. So at this point right here, my lot size was 2, right? And this is a lot, guys. Hey, this is a lot. Don't find yourself trading Nasdaq with this a lot size account. And then after price giving me this first opportunity to enter on the market, I was like, cool. Thank you so much for the point in price to allow me to enter that 2. Now I want to put another entry. Where can I put another entry? I looked at the market and I was thinking, would I put my entry right here? No. Why? Because there's no fair value gap that I would like to trade right here. Again, nothing. Cool. We get and then price came back down, and then it consolidated a bit here. I wasn't convinced what the price is. Why? Because these lows are still open. Price didn't, by the time price in AC at the low of the London session and the Asian session, right? So at this point, I used this order block as an entry, and then my take profit, what it was like, so this previous high was my point of, but like where I put my stop loss, and then I aimed for that low, and then the lot size against I made it 1. That's my lot size one I have. So hence why rebita a pyramid entry. If at all when another opportunity to sell, maybe to sell here or here, I would have made the lot size 0.5. Hella. Why? To reduce like I reduce risk. And you would probably be asking yourself that why didn't you just put another trade here? Because I got to show what the price I got. Cool. I didn't want to do that because price already in a security equilibrium. It's more discounting. And like I said, I don't want to be selling on discount. I rather sell premium going discount, not selling discount going discount. I don't know what I am. You understand? So immediately as price crossed the equilibrium level, I stopped looking for another opportunities to trade, to enter shorts, right? Cool. And then I was so convinced what the price was going to go to my low, to the lows that I was marking, right? And that was basically how I traded the day and managed to get my profits. And when you are doing this back testing, now I'm doing this because I already took the trades, and for me, I'm going to take the screenshot and put it away on my archives. What you'll be doing on your charts when you are marking this up, you should be having something similar to this, but on this area steady empty, these white areas steady empty. This is where you should be writing, or okay, a swing high was formed. Formed. I was then expecting even if you didn't take the trade, you write that you took the trade. You saw the opportunity of a high probability trade and you took it, right? You know what this does? It's a subconscious. Have you ever heard of somebody, or have you ever seen somebody lie so much, tell a lie so much that they end up believing it? Even in the future, this guy was lying. What is lying? Why is he still telling people this lie and he was actually doing this? And then when they're still so confused, still so convinced, no, dog, you know? Similarly, this is what you should be doing in your charts when you backtest. In the future, you will house it to these things will easily be going to be easy for you to spot them as they happen, right? Because that when it comes to the charts, we don't just it's not just about knowing your entry and all. Of course, you should know your entry, but sometimes it's gonna come with experience. There are times where I would know, okay, you know what, I think price may not go take the low of the Asian session today. Why? Because you've been trading so long, you've been looking and studying the charts so long that you know, or on a particular day, on Tuesday, it won't do that because it has to create, I don't know, some form of reversal or manipulation to trap in traders, and then that's when all the London session lows created Thursday. That's when you start looking to take the lows that day. I get cool. That is just from experiencing or just learning the charts. From there, you get to measure. Okay, how long did price take to go from my entry, which is here, to my take profit? It took 11 minutes. 11 minutes was delay 1,000 US dollars, right? Cool. You write that down. My take profit was hit in 11 minutes. For all these things, you note them down and say, like, house now hater, okay, my take profit the other thing that I used to write now, I used to write how far did price get to my did it even get close to my stop loss? How far did it get close? Did it touch my stop loss? No. One thing that you guys should note down, it's very important for you, in order for you to spot a high probability fair value gap or a high probability trade. That fair value gap should have an order block. An order block is just simply a series of candles. Let's say in this scenario, a bearish order block is a series of up close candles. So in this scenario, I can say this fair value gap order block yaron, it's these two up close candles. I like to make my order blocks as the body steady candle because it's more accurate for me. I don't know about you guys, but it's more accurate to mark the bodies of the candle. That's my order block. And then right there we have our fair value gap. Let me mark it with a different color. Let me use green because that's where the money is. Ka-ching. So yeah, this fair value gap has an order block in it, right? And price came, touched it. Just look at how many times price failed to even close at the 50% level of this fair value gap.
Okay, maybe going back to the order block. In order the order block is two close candles. Are they supposed to be the same or even?
Yes, they are supposed to be the same. If at all, when this down close, I think this up close candle, let's assume it's a down close one. The order block is the blue and you go dim, the top one. So an order block is the last, a bearish order block. Yeah, cause on what a price say change its state of delivery. Because an order block is just a series of candles that change the state of delivery of price. The bearish order block is these series of two down close candle at the down up close. Damn. Two up close candles. It could be 3, it could be 4, sometimes it could be even just 1. The last
they'll have tails going down and no wicks up.
No, these candles have wicks. They would have wicks anyway. That's why my order blocks I like to choose the bodies of the candles. It's more accurate. Most of the times choose the last the whole candle in the wicks and everything, but order block. Price can trade up that. Let's say it's a candle like this. Price has a tendency of, let's say, it reacts to this order block, like this kind of candle. Is it a hammer or something? Yeah, I think this kind of candle is called a hammer. I'm not sure. And then
it's a hang.
Yeah, that. Then price it traded through this this body of the candle, this body, the high the body of this candle, the top of the body of the candle, you're near up close here, and use it as support to go further up. So now I usually just use the bodies of the candles as my order blocks, not the entire wicks. I don't do that. It's more accurate for me. That's what I've seen. Even with this, just look at this. Yeah, no, I didn't even touch it. But try to keep close attention to it. Even this candle right here, it's an order block, right? Look at how the price, this candle wick reacted to it. This candle didn't even close above the body of the candle. Even this one in Ekile, this order block right here. Price was reacting to the midpoint of the body of the candle. Can you see this? This up close candle. The midpoint. Price about the midpoint in the future. You should just note it down. Where the price reacts to midpoints of things, of fair value gaps, of order blocks. It's even of wicks, candle wicks. Price reacts to that. Just pay attention to that. We will talk about it in the future. So without making this lesson very long, can I say 1 hour 30 minutes now? This is just how you should be framing your trade from the Asian session and the London session, right? And then you use that thing I was teaching about. You mark your 830, and then 830 you mark the previous highs. Which high was taken out? After taking out that high, was there displacement with the market structure shift? If yes, in that displacement leg, did you get a fair value gap? If yes, now we already made a trading strategy with tick boxes you can always check. Was it within 8:30 and 11? Yes. Did price trade back into the fair value gap? Yes. Where do I put my stop loss? At the previous high? Cool. Where do I put my take profit? Your take profit should be either at equilibrium, a PD array that's at the discount. That could be in form of a fair value gap. That could be on a previous low. That could be of a previous day's low, right? That could be, it could be anything really, right? That's good. Those are the things in order you should always be looking at when you are trying to take a trade. So it's best, like my guys, it's best to back test before you can forward test. Try doing this on previous price actions from previous days, and then after you feel like, okay, no, I understand what's happening here. Now, when price is continuously to happen, when it's continuously taking place, that's when now you can start looking at price as it prints to see if it's something that you can fathom. It's something that you can do, right? Just by looking at this, if at all I'm a scalper, which I am, I would create um, a narrative on this trade. A previous low was taken out right here, right? This low, it was taking a previous low out. Was there a previous high? Yes, there are two EB. Doesn't matter which one I choose because they are being broken by one long candle with displacement, right? On this displacement leg, displacement can occur in 3 different or even more candles. On this displacement leg, do we have a fair value gap or fair value gaps? Of course we do. How many do we have? We have 1 fair value gaps and 2. Shit, and even 3. Which one do I use? Are you going to use this one? Of course you can use it, but you're going to risk more, right? You use the fair value gap, it's on discount. Which one is on discount? It's the one at the bottom. Cool. Ridrisa, like dealing range, yeah, that displacement leg. Remember? Cool. Now price came down to the fair value gap that's on on what you call it, on discount. Immediately you put on a trade, and it gives you 3 times to try to put an entry there. It gives you an opportunity to enter here, then it gives you another opportunity here, and then another one. Oh shit. God damn it. Okay, now you can tell. And another one here. Right? Three opportunities to sell, to buy. And then where could be your take profit? You could put your take profit on the next high, just to, you could use this high, these 3 highs. I didn't say to me these are relatively equal highs. I want to see price come and take these highs. And why do I think price might even go there? There's even a fair value gap, right? Then let's just mark the closest high. And this is where I would like to see price go, if at all I was going to trade this.
There's also a fair value gap on the move down on those bearish candles. Sorry, on the long one. On the to the left of it.
Also, of course, now no measure this range from here to this low. Whenever you are buying discount, and there are points you can remove your trades on the next PD array right here, or even these 2 up close candles, kitty order block. You could use the lows of it as your what do you call it? Your exit points, right? Your take profits, right? Level. What did price do? It came back from discutting from premium down to equilibrium to give you another opportunity to buy. It's close to another fair value gap that has an order block. This one in this one. Look, price is rallying up, and then we all make money. But of course, this might easily turn around and go because Canada sits on a higher time frame, sits really too deep in price. I really don't want us to chase. But based on what I'm seeing here, this is a liquidity pool. This was, this was consolidation. Even at this point, price came so consolidated a bit. Market structure shift, displacement price is now rallying up to take the highs. Highs and outside these highs, it's an fair value gap and then it continues back down. Because this is what has been really happening. These candles, price takes those highs, gets into the fair value gap. You see that? Continues down. Same thing, fair value gap, market structure shift, continues down. Hella. This is how price reacts. This is how price prints. It's algorithmic. It's based on time. It's based on conditions like this, your Asian lows and highs. It gives you a lot of opportunities to say, no, I don't want to risk a lot. Let me just put my take profit hella the low of the London session. Or no, let me just take on the first fair value gap that is formed within the hormone, beneath the equilibrium, right? So make sure you practice this. You do as I have been doing. Write down notes. I do this every day. On days that I took trades, whether it's a loss or a win, even if it's a loss, I just look at where did I go wrong, what happened, and then I take a screenshot and I save it. You could make a folder maybe that has maybe trading or what 2025, and then you put the Motenga folder at 2025. You write January, you have the folder at January through December, and then each and every day was add a screenshot. The next year, you do the same thing. Eventually, you're going to have 3 to 4 years of data that you can see, okay, where do I go wrong? Where do I lose the most? Let me cut it out from my trading strategies. I lose on Mondays, like I told you the other days, where I lose a lot on Mondays. What should I do? Should I trade more on Mondays to try to be better? Or should I just take Mondays out of my trading days? Right? I took them out based on that information you can keep. Right? You don't losing trade over fuck, now I'm done. But the only trades that you journal or you take screenshots of and save, get a how win. That's just injustice to yourself. Right? So yeah, that's all that I had for you guys today. Oh shit, look. The market might just come and take these highs. That's what I had for you today. We were learning how to trade using the Asian session and the London session as your map to mark where price might go. We were also refining our skill in determining where to take an entry by the market structure shift, fair value gap, with the market structure shift with displacement, fair value gap, the liquidity sweep, all these things. Right?
All right. Yeah. I think it was a very informative lesson. So will we have access to this video or the?
No, immediately I guess exporter. I'll try by all means at least overnight upload. I think it's good load some about 2 GB or whatever. But I'm thinking of I have a YouTube channel, linky. I'm thinking of just uploading it on the YouTube channel because I get YouTube, it's a bit optimized. Level on different qualities so that you don't, some of us have this mobile data. Imagine how subscribe to 2 GB video and it's at 2 GB, right? It's yeah. But I'll just give you videos, guys. Videos more thing happen on my channel where I was talking about such things, both the power of 3 and all, right? But I'll try by all means like I can this video it's like I think capacity guy, spaces guy, and then if at all it's less than a GB, I'll just send it through the group. But if it's more, get like upload more YouTube and then I send you guys the link.
All right. Just send whatever you can, the links wherever it is.
Yeah.
Even your YouTube, just send the link anyway so that we can browse that material.
All right, no problem. All right, guys.
Thank you.
Oh shit! Look at this. Hey, go again to the trade. Wait. Prices usually when something like this happens, price usually rallies through this with momentum. If it's a specific high, I wanted to reference Makantele. I think I was trying to reference this equilibrium. They don't matter to the markets. They do. Look at how price is reacting to the equilibrium. Let me remove this. Wherever price interacts with equilibrium, it's either it rushes into it and leaves out a wick, or it rushes with momentum, or it just touches it and then goes down or whatever. You see, these are price points. Even this side, even the far left, touches it, goes up, touches it with momentum, hella. You see? So these are some of the things. We level market and we mark them down, write them down. In the few years to come, only ICT guru, better market. Ha Dubai hali. Oh, kikio trade you, take it in, 100,000 fast. You are gone. You understand? But yeah, with that being said, guys, if you have any questions, any comments, feel free to do so. Or if at all you feel uncomfortable, just feel free to send me a private message. We'll talk, and then get those things in the next lesson. So what's or I can answer them now if at all you have a question.
I'm all good. Thanks, man. But so that point, that high, niggas shock the market structure shift. So
Right here?
no, you need that
Okay.
thing. Niggas shock the market structure shift. So now, you don't know any on which you can that's wabana on the left one. You're lefting, yeah. Left. No, not that's right. Left.
Oh shit. Okay.
Kono. It's in after that.
Yeah. Yeah,
Eh,
like I was saying, like that. You should. Well, one of the swing low eke makilenke hevona. Tell me what it
go.
actually breaks this high. I think it's actually broken by this displacement leg, right?
Yes.
If you look at this displacement, yet displacement in only a swing low. This is a
Hey.
swing high. This is a swing low. On a lower time frame, on a maybe I don't know a 15 seconds time frame, price action I think in there. And we don't want to see that, man. We just want to see price breaking down. High listen in the candles the multiple one of these candles the 1, 2, 3 key displacement inside. Right?
Yeah. Yeah.
Yeah.
Yeah. Go tell.
Even look at this. Even this displacement still. It is broken by this low. It is even broken by this low. And then price didn't even go back to that high. Why not just be sure what how on say how something that happens like this?
Yeah.
There are things that are going to tell you or you know what, price is not gonna go further than that high until a PD array or a previous or a liquidity pool is taken out.
Yeah.
This basically on the lower time frame, there's a fair value gap, but like a swing low, a market structure shift, fair value gap. Until this low was taken, that high being taken. Wow. But if you look at this, it's happening on our time frame, and that things tap on your hand. No, we are not gonna go up. This look at how the market. Let me just remove this fair value gap.
And the way kake makileng ka teng is the way that ka o makileng ka teng. Mara market structure shift in exam maka gothelela.
It's important. You were trading out of your trading rules. Okay, this is why it's important to have written down trading rules. And you didn't take your AR market structure shift with displacement, right? Market structure shift, displacement. Price came back to a fair value gap that was formed during that market structure shift. And then in a order block, price failed to close above that hormone, that midpoint order block. Even this one, price failed to close at the midpoint of the fair value gap. So what I said, price hike even if you would have taken a trade here or here, price still didn't even go back up. It's simple. It's just telling you, man, we are not going up until our objective is done. This is a typical kind of trade. It's a high probability trade. This is the kind of trade I think. Yeah. No, better yet next time, my nigga.
Again.
Yeah. If there's nothing else, if there's anything else, I'll count up to 5 seconds. 5, 4, 3, 2. Okay, I think that marks the end of our lesson. Thank you so much for attending, guys. I hope you got so much value from this lesson. Whoa, shoo. Well, one of these highs is taken when these highs were taken out. They were taken out with displacement. Not to say what it's a market structure shift. I'm just saying what it marks a significant high being taken out. So yeah, guys, we'll talk again linked or what's on the weekend. The Friday, maybe I'm going out with my girl. Saturday, I'd like to take rest on those days. I have an events management company. Like I said, these are times saying what I put some work in. And then Sunday, that's when that's when we can now sit down and dissect the market and see where it might probably run to, right? I'll just stop the recording right now. 1 hour 33. God damn. And then